I will say that I do have an unpopular view that I think that not only algorithms, but also financial models and just the widespread use of math in the investment management industry is, while it can be helpful, and I'd like to talk about all the areas where it can help a manager, I think that there's been some pretty significant over-reliance on those things. I think they're useful tools, but I don't think they're sufficient for investment success.
Okay. Can you give some examples of areas where we've seen it to be over-reliant to the point where it becomes a detriment to the strategy?
Sure, sure. I first started focusing on this issue a couple of decades ago. I think most of us will remember the downfall and the implosion of long-term capital management. So that was a very that was big news at the time. This was in the mid to late 90s, and an algorithmic strategy. The fund itself was actually run by a number of Nobel laureates. They had more than one, I believe. I think they had two. So very much in the vein of, relying on algos and computers and math to drive the investing process. More recently, in the late 2000s, the global financial crisis. A lot of people may still remember that in the 2000s, quant funds were very popular, were all the rage. And during the global financial crisis, a lot of them unceremoniously shut down because the results that they promised people didn't materialize. And when the GFC happened, they didn't perform as expected. And what's ironic is, 2020 rolls around after the longest bull market ever, more than 10 years, and it doesn't seem like much has changed. In Q1 of 2020, during the COVID-19 market crash, we see something very similar happening, where this time it's a number of very large hedge funds, as well as some robo-advisors that use a strategy called risk parity. And a lot of these funds have marketed this as an all-weather strategy. Unfortunately, it didn't protect the investors when the storm came.
Yeah, and I've covered the hedge fund industry for about the entire time that you mentioned, going back to the early 2000s. And to your point, I know that quant investing is not new at all. It was big in the mid 2000s. It was big in the early 2010s. It's big now. But what is it, you think, about these strategies that they get wrong?
Yeah, I'd like to dive a little bit deeper later into risk parity specifically, because it's fresh on everybody's mind. But I think that the over-reliance on math, financial models, algorithms, computers generally, it stems from some biases that we have.